What if I told you one man's crazy idea helped change U.S. law, unlocked $3 billion in startup funding, and gave everyday Americans a shot at investing in the next unicorn? Meet Woodie Neiss, the Wall Street dropout who flavored kids as medicine, charmed Congress, and sparked the regulated crowdfunding revolution. If you've ever dreamed of backing the next big thing before the VCs do, you owe it to this man to listen. Welcome to Angels, Exits, and Acquisitions.
I started on Wall Street. I've had some success. I feel like I know what success looks like in some of these companies, but I also feel like the data shows signals of the companies that are most likely to go on for a follow-on round of financing. And one of the ways that we can prove this is...
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes. This is Angel Investors Network's podcast, and I want to introduce you to Woodie Neiss of Crowdfund Capital Advisors. Woodie, how are you doing today?
I am great, Jeff. It's exciting to be here because what I live and breathe is exactly what you guys talk about.
Beautiful. Well, I'm looking forward to diving into this conversation and learning more about what it is exactly that you do and how you help people. But before we get there, why don't you tell us a little bit about yourself and how you got to where you are today?
Okay. I started my career on Wall Street. So I worked on the trading floor for PaineWebber, which is now UBS. On the commercial side, I switched over to the retail side in San Francisco. I realized that was not the career for me. So I went to work for a Silicon Valley startup by the name of PeopleSoft. I learned all about...
I know them very well, actually.
Oh, do you? Yeah. Great. Like a phenomenal venture started a company that scaled and had a big exit acquired by Oracle. I just learned so much, not only about how you Fortune 500 CFOs run their businesses, but how you scale a hypergrowth company with the assistance of angels or venture capital and how important of a role that they play in that. And so I left that and started my own healthcare technology company called Flavor RX. We flavored medicines for children so they're more compliant. We grew that from one pharmacy to 40,000. That was also venture funded. The VCs that came in and looked at our books were like, how do you have such like amazingly clean books? And I was like, well, I learned it all when I was at PeopleSoft and they were flying me around the world to meet with these Fortune 500 CFOs. But we sold that. And the entire time I was running the business, I would get phone calls from mothers. And they're like, listen, I know, you guys flavor medicine and I got my kid to take the medicine. You don't know me, but my kid would not take their medicine. Like we were back at the doctor's office. We were at hospital appointments. It was just nonstop interruption for our family. And now that my kid's taking the medicine, like you solved a huge problem. How do I invest in your business? And I would say, that, thank you so much for that testimony. Can I get your name and use it? But you can't, like, unless you're rich, the only, rich people or VCs can really invest in startups. And I thought that's such a missed opportunity. Why can't people that know what I'm doing, that believe in what I'm doing, that have seen what I'm able to accomplish, invest in me and my business? We ended up selling Flavor RX in 2007, right before the Great Recession. But during the Great Recession, if you remember what happened then, Washington was looking for jobs. And I was living in DC at the time. And so I said to my friends from Silicon Valley, maybe now is the time that we need to take the principles of crowdfunding, rewards-based crowdfunding, what Kickstarter and Indiegogo were doing with what Kiva was doing with microloans to entrepreneurs in other countries. And I said, if we can merge those two principles and come up with our own version of online investment, like early stage venture capital from our friends and family, maybe we can help get capital startups, create jobs, and kickstart our economy. So we brought that framework to our friends on the Hill in Washington, D.C. The SEC thought it was cute. They invited us to go over to the Capitol, which we did. And naively enough, we just started walking the halls of Congress. We were able to build bipartisan support. Patrick McHenry, who's a Republican from North Carolina, became our chief advocate and champion for what we were doing. He took our 8-bullet-point framework, turned it into a bill. I was called to testify at a hearing in front of the House Financial Services Committee. Did that. The White House had someone at that hearing they were listening to what we were doing. They called me and said, we're interested in what you guys are up to. I gave them a 2-page write-up. They came out with a statement of administrative support saying, if you pass this, I will sign it. So we did the lobbying in the House and the Senate. It passed the House 407-17. It passed Senate 73-26. And then we got to go to the White House as President Obama signed our crazy idea into law. And it launched this industry that is now called regulated investment crowdfunding. And it's a $3 billion industry. 8,300 companies have used this to do 10,000 rounds of financing. They've raised over $3 billion to date. And it's really transformed what's happening in early stage finance. So I decided that we would become the data experts in the space, much like Bloomberg. And so we built a database based on my experience at PeoplesOft and databases that aggregates information on all the companies that are raising money. So we look at their offering documents, what they file with the SEC, what's on their offering pages on these platforms other than websites, really. And we aggregate all of this information, 150 data points. And then we do all this research and analysis on what's happening in this segment of the marketplace, which has led to just a ton of other things that we're working on.
Very cool. So you helped pioneer the Jobs Act.
That is correct. I am responsible for Title III regulation crowdfunding.
Very cool. Very cool. Well, congratulations on that. I know a lot of people are very thankful for that. We've had a lot of our clients go on different crowdfunding platforms, and some with some great success and others with moderate success. But, as you know, you can't win every single opportunity out there. But, it's definitely created a whole new industry, right? From, obviously the portals and the way that broker dealers interact to the way that just retail investors can get access to all these things. So, I want to say thank you for that. That's been a pretty profound shift in how companies get started and get funded. And it's definitely changed how we do business too. I used to tell people when you came to the realm of going to start a company, what'd you do? You went to we call it the triple F round, the friends, family, and fools round, right? You had to go through that route. And then hopefully you could find some angels and hopefully you could get enough traction to get that going. But now crowdfunding between Reg CF and Reg A Plus has really changed that. You may not need to have, checked all the boxes like all the sophisticated investors really wanted you to do and show the 3 years of run rate and the 100% year-over-year growth because, hey, if you're really good at telling a great story and you have a really great opportunity here, then people can get involved a lot sooner for a lot less money, which is great. That's awesome. So again, thank you for that. Now, I do want to talk, before we dive even deeper into that piece, the whole PeopleSoft thing. So I'm one of those people that remembers PeopleSoft, and before it was even, acquired by Oracle, we adopted the ERP essentially for running our inspection business. And I wasn't the CFO at all. I was a lowly guy on the totem pole at that time. But I was the one that learned how to get into the back end and build the macros and build the scheduling tool and all that sort of stuff. And it did eventually result in about a 30% efficiency gain in how we were doing our work. And that was kind of my foray into data and analytics and big databases of what we were going. We had 5 million locations we had to service. We had 4 million miles that our team would travel every single year, 250,000 inspection visits every single year. So it was like, it was a lot of work that we did. So it was pretty interesting to hear that. That's like a blast from the past, listening to, somebody talking about what you did at PeopleSoft. So very cool.
I mean, they were, it's such a perfect example of a company that looks at problems that exist in the marketplace. And they're like, why do we have all these legacy programs? Why does, manufacturing and production have one, finance have another, sales and marketing have another, HR has a different one? How can't we just pull it all together? And, Dave Duffield was just a genius who saw the opportunity on building an ERP that pulls everything together and built such a solid one that it was used globally. It's just the nature of, entrepreneurs, how they think, I see a problem, it's a solution and I have the capability to build it. And now with, investment crowdfunding, what's great about it is you don't have to be in San Francisco or New York City anymore to get this capital. You can be like, I'm in Denver. Like you can have a great startup here in Denver, raise money locally from the community here, prove the concept. And what that does is it provides that introduction to the VCs because, regulation Reg A is for bigger, more established companies that really want to leverage that. But investment crowdfunding only works for a limited period of time. You can only raise up to $5 million a year. If you're a hyper growth company, like PeopleSoft would have jumped out of it immediately. So it serves a niche. It serves a need. Like we solved the valley of death when before, investment crowdfunding was a thing. You had to come up with your own money from 25,000 to 250,000. Figure out where you're going to get that. Before that, it was like your credit cards. But investment crowdfunding has solved that problem. And now you've got people that can access capital, get innovation going, and really move it to the next level.
Yeah, absolutely. Well, it's changed where VCs fit in, where angels fit in too, in a lot of cases, right? We're all familiar with Shark Tank, and we would run our own events called Pitch Tank for a while. And, it's great that there's this thing called Shark Tank out there, but let's be honest, most of the stuff that goes on Shark Tank is literally, it's a sales and advertising opportunity, right? It's not really designed for, B2B tech companies or things that people can't go and buy off the shelf somewhere. And having these Reg CF portals out there have also filled that gap, right? It allows people to say, hey, this really cool new AI tool or machine learning tool or, technology. Like one of the companies we helped out with was creating brand new turbines, wind turbines. And it's not something you would buy and install in your house, but you could. And so it wouldn't really end up on Shark Tank necessarily until they got to a certain stage where it was like really good show and tell, right? And now they've raised, I think, somewhere in the neighborhood of $6 or $7 million over the last several years. So it's stuff like that it changed the way that people could actually bring a product to market as well, because you didn't have to have, like I said earlier, all the bells and whistles and all the I's dotted, T's crossed and boxes checked just to go out there and start raising money, right? So it has really changed things, and that's a great thing. So now with what you do here, crowdfund capital advisors, like you said, you gather all this data from all these different places and portals, I imagine, and different capital raises. What are some signals that you've seen, whether early on or now or over the course of time, that really help you understand whether a company will succeed when they're doing, crowdfunding?
So everything that has existed in the private capital markets before investment crowdfunding was learned after a round of financing closed. So a round would close, companies would report on PitchBook or Crunchbase, I raised this amount of money from these VCs. And if it was big, you're like, that's pretty good. And if the names were, ones that people recognize, they thought that was also a positive signal. And those were the main driving signals in the private capital markets before investment crowdfunding. Everything changed once this law went into effect. And we've got two new signals on the investment side that are driving what we're talking about in terms of awareness and bringing things to the top of interest. And those two signals are the number of checks that are being written into a deal on a daily basis, the total amount of those checks on a daily basis, and of course, if you divide those two, it's the average check size. We call that investor sentiment. And so within the data set, we're tracking investor sentiment on every single active offering. And right now there's over 400 active offerings on a daily basis. And we're looking to see which are the deals that are getting the most checks into them on a daily basis. Because what's going on? What do these people see that I don't see? It's a signal of we need to follow the traction of this crowd to research and diligence the deal to see what the opportunity is that we might be missing. A lot of these opportunities, like I said, are not happening in Silicon Valley and New York City. So unless you've got access to the entire data set like we do, it's very hard to figure out where the gold is in the haystack or the needle. And so that's what we're looking at. We're looking at that signal of investor interest. And then we're also looking at the check sizes, because if check sizes are increasing, that means people are willing to risk more capital. If the total amount that's going into these deals is also very high, that means there's something going on there that we should be looking at. Why are so many people willing to risk so much money to go into a deal? So what we did with Crowdfund Capital Advisors and the entire data set is we said, it's gotten too much. Like 150 inputs on every single offering. We have now over 5 million data points in the entire data set itself, from transactional information to just all that information we collect and annual reports. I said, we need to have an algorithm. We need to leverage what's happening in the marketplace today. We need to figure out how to use AI and machine learning to build an algorithm that can help us sort, filter the data, and come up with signals for where we need to look for opportunity. And so we sat down with 3 data science PhDs a few years ago. And I said, this is who I am. I started on Wall Street. I've had some success. I feel like I know what success looks like in some of these companies, but I also feel like the data shows signals of the companies that are most likely to go on for a follow-on round of financing. And one of the ways that we can prove this is I have rounds of financing in the data set. So with the companies that have gone on for a follow-on round, we can see the revenue growth. We can see what milestones that they've hit over the course of that period between rounds of financing. And I was like, if we can integrate this stuff into the data set, then new companies that come in that have matching signals should be the ones that we look at to diligence. And so we did a couple things. One is we created that algorithm. We tested it. It took us a year and a half to build. Then we tested it for a year. And then we started making our own investments off of it because we're like, well, why don't we just profit off of it? Because, this is, everyone knows the earliest that you get in, that's the lowest valuation. So they're not all going to be winners.
Hopefully.
Right. But if we can invest in a broad basket of these companies, maybe we can have many outliers instead of a few. And so then we built a venture fund around this too, called D3VC. And we make investments through the venture fund into these select companies from the algorithm. But we also decided, let's sell these signals. So we created this report called the Capital Pulse Report that lets anyone look at the top signals that come out of the algorithm on a weekly basis. And we tell them, this is a signal. It's not guaranteed. Diligence still has its role and its place. You still need to look at these offerings. And I tell people all the time, if you want to win at this, one of the best ways to figure out if the company is going to win or has a chance of winning is look at what other people are saying. One of the things that I love about what we build with investment crowdfunding is we said that all communication needs to happen on the offering page. In case that's the website where these people are raising money. At the very bottom are these discussion areas, these part of the page. And there are, if it's an AI company, you're going to have, people, experts in AI that are asking questions. If it's a, healthcare company, you will have doctors on there saying, I question your scientific basis for what you're doing. And so it doesn't, if it's a burrito company, you're going to have people saying you're using the wrong rice. It's hilarious, but it is learning. And I'm not an expert in healthcare. I'm not a scientist, but boy, I can learn a lot to help inform my decision just based on what I'm reading at the bottom of those pages. And so the signals have led to this entire venture fund. It's led to this Capital Pulse. And I think it's creating a better ecosystem for investors all around.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
I agree. I mean, that's a lot of data. And we've always said that, the company that leads with data and understands the data will generally win, right? And investors that can do the same thing make more prudent decisions. Angel Capital Association came out with a report a long time ago, and it talked about the number of hours of due diligence that go into your investment decisions impacts the overall return that you're going to see across your portfolio. And if you spent less than, say, an hour of due diligence on a company, your returns were like nothing. Versus when you spend over 100 hours, your returns are in the 30, 40 percentile or percent per year and on an IRR basis, right? And so, it's one of those situations where having the data available is really important. Being able to pull the signals out of that data is also very important. And then being able to take action. So that's very cool that you guys have been able to build that. Now I have the question though. How are you able to get this data? Because let's face it, crowdfunding portals don't want to share all their secret sauce. So is it like some sort of a trade secret? Or are you guys just basing it off of what you guys are seeing on the public side of things?
So we collect information from every single offering that's filed with Edgar, and that's where everyone has to file a Form C with Edgar. So that's all public information. So we pull that in. Then we go to the offering documents. So you have the law that we created says you have to have a business plan, a use of proceeds, evaluation, and how you came to it, a bunch of different disclosures, all your financials. We go into all of that information and we start pulling bits and pieces out of it. Things like, what industry you're in. We've got 23 sort of roll-up industries, but we tag every NAICS code. There's been over 550 NAICS industry codes within investment crowdfunding? Like, that blows my mind. And so we pull, like, are there women and minority founders in there? We pull that information in there. We want to know, has any VC or accelerator been on the cap table? All of this is through research that we're pulling into the data set itself, that is part of the algorithm now. And then what we do is a very tedious thing, and it's either sped up through integration with the platforms, files that we receive from the platforms, or research that we do on a daily basis ourselves. But remember, I told you there's 400 active offerings. That means that we need to visit 400 offering pages every day and capture the number of checks that have been written and the total amount that's been committed that day. And if you started the data set like we did on May 16th, 2016, you can have a 100% complete data set that goes through today. And so we can see all of the transactional information that's happening. So, what's amazing about that is we saw what happened pre-COVID, leading up to COVID. We saw the impacts of COVID. We saw what happened post-COVID with capital flows and just in general with this segment of the market. We've seen the recovery. We saw the impacts of hyperinflation, and what happened in terms of supply chain issues. All of that within the data set, but it's because we're looking at the EGR filings, we're looking at the offering documents, we're looking at every single open offering on a daily basis.
Oh, that's very cool. And this is going to give investors a lot of insight, right? Like they're getting a chance to see, because poke me in the eye if I have to go and look at every single crowdfunding portal or platform out there to try and figure out which ones are doing what. And God help me if I have to subscribe to another one of their email lists and get all the updates, right? You get enough of those from just a couple. But this is really helpful. But now talk to me a little bit about, on the company side, the capital raiser side, the issuer side.
Mm-hmm.
What are some leading indicators they can look at to say, okay, these are the things that have made this other company, like we know, the EDGAR filings, the Form Cs, okay, great, they've raised this amount of money, that's wonderful. But what was it that they did that made them successful? Do you guys capture any of those kind of signals as well to help these issuers do a better job?
I mean, we look at empirical stuff within the data set itself. So we look at the videos, and the videos really can tell you a lot. One, how much money do they have to put into a video? If it's very well done and polished, it could just be a good team that's putting it together. But a video is meant to answer a lot of questions in a short period of time. So the ones that introduce the team, the problem and the solution, why you need the money that you need, how you're going to use it, and why people should be engaged in doing it, and that it pulls your heartstrings, are the ones that are the most successful. The other thing, which should not be obvious to anyone that's listening to this, is hitting a right valuation. We've all seen how valuations have skyrocketed over the past, 5 years. And when the industry started in 2016, the median valuation was $5 million. Now the median valuation is $12 million. So it's gone up too high. So the companies that spend the time figuring out what is my right valuation for the stage that I'm at, and I want to reiterate the stage that I'm at. There's 4 ways you can look at this. You can be a pre or post revenue company, and you can be a startup less than 3 years old or established company over 3 years old. We segment all valuations based on those 4 criteria to let you know where your valuation should be. So companies that spend the time, we've taken all the data and turned it into products. We launched this product called the Offering Insight Report. And so now companies fill out essentially what looks like a Form C, which is that form that you file with the SEC. And then we give you a 10-page report that gives you comps on your company to other companies in your industry at your revenue growth. So you could see how much money did they raise, what platform did they raise on, how many investors did they get, what were some valuation ranges from those companies to yours, so you could see, are you on target with that? Because you don't want to go out with too high a valuation. Boy, let me tell you, just read the comments where some of these valuations are. There was a company, I'm not going to name them, but they're a beverage industry. They had good distribution in the southeast part of the United States. the revenues were, I want to say it was like 7 million. They had a $150 million valuation.
Oh,
And I was like, what kind of, hallucinogenic are you on? Like,
yeah.
no, 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 that just doesn't fly.
Yeah. It's such an important thing, right? When people are looking at this, correct me if I'm wrong, but they can still only do up to $2,000 per investor on Reg CF, or has that rule changed? And remember, there was originally an income threshold that they couldn't go above.
It's 10% of your income or net worth. So whichever's greater.
Okay, okay.
Anyone can
So,
invest a minimum of $2,000, I think it is.
gotcha. Okay. Um, so with that being said, these are people that they want, like you said, they want to get emotionally invested, not just financially invested. But let's face it, they're not doing it just as a charity, right? They do want to get a return. And if you're telling me that your company's already at a $150 million valuation with a $7 million revenue, boy, you better have some sort of rocket ship in your back pocket that's going to take you to the moon and be able to prove that, because otherwise it just doesn't make sense, especially in a beverage space. Um, but you're right. I mean, being able to understand valuation, so many people, it's hard not to name names sometimes when you want to talk about these stories, but we'll be nice and not talk about some of the companies and some of the foolishness that's out there. But when people say, well, I had a guy come up to me one time. He goes, I don't have a unicorn. I have a Pegasus idea. I was like, what's a Pegasus? He goes, I have $1 trillion business. Okay, cool. I've heard everything. At least I keep thinking I do. How much money have you? Well, we're just in idea stage right now. I'm like, okay, well, it took a few decades for Apple to get there. So,
Right.
not saying you don't have it, but on the other hand, can you prove any of it yet? And if you can't, and let's just face it, no one starts out the gate saying they're $1 billion company or even $100 million company, right? But some people do, and they wonder why they struggle to get the money they need.
What's interesting about what you're saying too is I think a lot of people might be thinking that the companies that are coming to raise money online must be the ones that can't get venture capital or angel investment. But the data shows that the average company that's coming to raise online has changed dramatically. When the industry launched in 2016, 65% of the data set was pre-revenue startups, the riskiest. Now,
Mhm.
65% of the company are post-revenue established companies over 3 years old, and they have average revenues of at least $1 million. So the profile of these companies coming in are ones that are actually at the point where, hey, I need to scale. Like I've proven my concept. I've gotten through some logistical and system processes that that every company goes through. I think in that $0 to $1 million phase. But now they've got systems in place and they're ready to scale to that $5 or $10 million, and now they need the capital to match that. That's where we're at, and so it is super exciting to be part of it. I mean, just to talk about the opportunities and the exits in the space. My business partner and I invested in one of the early companies in investment crowdfunding that was acquired by Circle. Circle just had their IPO last week, and we kept our equity in that, and it's already up 4,300%. So there is money to be made. No, not all companies will go public, but the opportunities are. I think all future unicorns will be born in this data set.
That's awesome. I love hearing that stuff. And I think one of the reasons that we're starting to see more mature, I guess, is the best way to use, or best word to use for some of these companies, more mature companies going to the Reg CF route, is because there was this like hype and hysteria, I guess, initially when Jobs Act came out, and we finally had the portals in 2016, right? And it's like everybody's excited about it, right? I think the excitement is somewhat waned a little bit. We've seen a lot of it, and I think enough companies failed that even did raise a little bit of capital that people are like, okay, well, let's be a little bit more cautious. But it's also forced the issuers that have come onto the platform and the platforms themselves to be a little bit smarter about, what kind of equity they give up, who do they go after, and they have to be able to spend money on advertising. Like, let's face it, when you first launch anything, if you're the only player in the market, it's really easy to get attention. When there's dozens and dozens of platforms now, you have to be a lot more strategic about how you go to market and how you get your message out there. And so that's forced these companies and platforms to be better at marketing and advertising and getting eyeballs on them, which means and we know this, if you don't spend any money on advertising to get your message out there, you're going to have a heck of a time raising any capital at all. And it's going to end up costing you money more than likely, right? Because you have to do the financial reviews or audits. You have to, go through all, like you said, filing the Form Cs, getting everything done properly, the issuing, listing it on the platforms, as well as, let's face it, they all take success fees, right? So I think it's forcing people to be a little bit smarter, which is, of course, allowing us to get even better companies and a better pedigree out there. Would you agree with that?
Absolutely. A few things. When we put this together, even the people on the Hill were just like, you're putting a lot of work in front of entrepreneurs. Should we have all this work? And my response was, listen, I started a company that was, we had angels and we were VC funded and we sold to a private equity group. I said, I'm pretty sure everyone wants to have access to this information, whether or not you're going to read it or understand it. So it's important to have that in there. So I love the fact that we put this in there because it not only forces entrepreneurs to learn, but to become better entrepreneurs, and it standardizes the entire process. So I think that was just really beneficial. Now, when people talk about how they thought the industry was going to take off from the get-go, I actually remember leaving the White House talking with Karen Kerrigan, who is one of our big advocates in Washington, D.C. She runs the Small Business and Entrepreneurship Council. And she put us in touch with the people on the banking committee and the House Financial Services Committee. And she's like, you guys have to do the work, but these are the people you need to talk to. And when we're leaving, I was just like, this is so exciting. She goes, Woody, don't get so excited. This is going to take 5 to 10 years in order to take off. And I was just like, what do you mean? And she goes, I've been around DC and this stuff long enough to know that this is probably like the FSA accounts. Remember we came out with those cards she goes, the first 5 years, nobody knew what they were. And now everybody has them. She goes, you will probably go through the same slow uptick. And there's going to be a tipping point at which I believe, by the way, we're in right now. VCs have moved upstream. Like the fact of the matter is, we're not going back to the way things were. Okay, that doesn't happen in history. That we've had the Silicon Valley collapse. We've created this void. This void has created an opportunity, I think, for angels really to step in. I think angels can learn from these signals to identify where they want to actually put their capital. But this is now going to be the world and opportunity for this early stage financing. And I think this is what we're looking at.
Yeah, it's funny you say that. We're pretty much out of time, but I want to put one point in here, which is creating this void. We call it the capital gap, right? We used to call it like the valley of death. They'd raise a little bit of money, but they'd never get big enough. It still exists. It's just changed, right? Now you can get done. You can raise maybe $5 million, and that's getting you well on the way to being a good company. But if you're not into profitability and you're still burning and you're still at a negative, cash flow, then you're only going to last so long. Well, if you don't get to those magic numbers that the VCs want, but you've increased your valuations beyond what the crowdfunding portals and even the angels want, you're in, again, the valley of despair. I call it the capital gap. You're in this chasm, and you have to find a way through that. And so that's sort of the role that we've taken on over at Angel Investors Network, is focusing more on that capital gap area. Because you're right, there's so many opportunities at the earlier stage, and there's so much money at the top end, right? I mean, trillions and trillions and trillions of dollars that are just sitting there doing nothing is dry powder right now. And so there's plenty of money up there, and there's enough money at the bottom to kind of get things going. And let's face it, you need to be resourceful as an entrepreneur to get going. But there is still a gap there. And so maybe we'll have you back sometime in the future and talk about that. But we are running low on time here, Woody. So I want to, before we wrap up here, I want to ask you one last question, which is, now that you've gone through all this, you've had incredible success, you've exited businesses, you've started your venture fund, you helped pass some of the coolest legislation, most meaningful and impactful legislation in the entrepreneur startup world ever. If you were able to go back to your younger self, when you first getting started in your career, what's one piece of advice you would love to give yourself?
Really, don't let the naysayers distract you. It's so easy for people to have negative opinions and tell you why you shouldn't do something, as opposed to focusing on the people. And there'll be very few, but there'll be those people that look at you, listen to you, and go, wow, you're onto something. And those are the people that you want to surround yourself with. And I think it's human nature to feel the negative people have a right and I should listen to them. But if I could go back to my younger self, I'd say ignore them.
Yeah. Here's to the crazy ones, right?
Right.
Awesome. Woody, this has been great. How do people find you and learn a little bit more about you?
So I wrote this manifesto book. It's called Investimers. It's 400 pages of my brain in a book that covers why this industry is here, how it started, and the opportunity in front of us. If you go to investimersbook.com, it has links to everything that I'm working on, and you can get in touch with us or find out more about our venture arm or the Capital Pulse or the data itself.
Beautiful. We will make sure we include that in the show notes. So if you are watching this or listening to this right now, make sure you go check out the show notes. We'll have all the links in there for Woodie Neiss's books and his business and everything else that's going on. So thanks so much for watching and listening to Angels, Exits, and Acquisitions from Angel Investors Network. Woodie, thanks so much for being here today.
Thank you, Jeff. Appreciate it.